Let's take a look at exercise 17-6, which is a problem dealing with comparative balance sheets that we're going to prepare using common-sized financial statements. Okay, in the brown area on the screen, you see the information for the Sexton Company, and we have some information for 3 years, the balance sheets from 2004 through 2006. Okay, now I've prepared a bit of this down below, and all I've really done is put together a screen for you using the information coming from the information that we were just looking at. I've scrolled down and I've dropped that information into Excel. And now what we're asked to do is put together the common-sized columns, which really means put them in as a percentage of something else, and that something else is total assets. So all we really need to do is take the various dollar amount from the balance sheet and divide it by total assets. I'll lock that in with a F4. I'll turn this format into a percent format by multiplying it times 100. Actually, I don't want to use a percent. I would rather use just a comma with the percent at the top will let us know that it's all in percentages. Okay, let's get rid of one decimal. Once I have that, I can simply copy that down. Okay, and that one needs to be a little bit wider to get that there. I will underline this, and why don't we double underline this format as well. I'll come over here, click on the double counting underline. Okay, now once we have that, let me just take care of the formatting in all the other cells where we need to do that. In fact, I could do all of this formatting just like that, and that'll be fine. Alright, then I'll put going down to 2006, we'll do the same thing. Equal the accounts payable dollar amount by the total liabilities and equity. But actually, since total liabilities and equity will equal the total assets, I can simply copy from any one of these, drop it down, and we should be just fine. And the only exception is once you've copied it, you change the format that was already there. So if I drop there, we've taken care of that. Okay, then I'm going to repeat that exact same step here. With the F4, I'll lock it in. Actually this time I'm going to copy all the way down. And then use my painting formatter to get that to look right. Excuse me. What I want to do is multiply that times. Let me hit the F2 so you can see that. Okay, just put times 100 so we get that to the right decimal places. I'll copy again. Delete this cell, widen it. Basically, the whole point is I'm taking every cell divided by the total assets. Nothing real sophisticated going on here. Okay. Let me shrink this a little bit because I think that's sliding off the screen. Come on over here a little bit, shrink this down. And take this cell divided by that cell, lock it in with an F4, and take that formula times 100 so we get it into the percent format. Copy that down, delete this cell because we don't need it, and then I will copy these here and drop that in here. Okay, now a couple things. Let me just widen this column so we can see it, and I see that I think I have a typo. I think this number should be 49,250. Let me slide up. Yeah, it's 49,250, so I've got the wrong number there. And I missed that. I apologize. Now the 372.5 from that cell and that cell match. We want our, that cell and that cell match. We want the debits to equal the credits. And these columns here, all the percent columns, why don't I just highlight all the percent columns and put them in a separate, different shading, maybe something like that. Those green cells then are the answers to what's required in the first part of this problem. Okay, the second part says analyze and comment on the results. Okay, well, let's just look at the numbers and I'll point out some things. One, if we look at cash, we can see that as a percent of total assets, cash has declined from 8% to 5.9% from 2005 to 2006. Now, if we've got enough cash on hand, that's good. That's telling us we're using the cash for other more important needs. Having it sitting in cash is probably not the greatest. You don't want to have too much cash sitting on hands. If you look at accounts receivable has increased, and this could be bad news in that we're tying up assets in an unproductive manner, and perhaps it means there may be some assets at risk of being uncollectible. Now, it could be good news if the increase in sales are outweighing these costs, and we expect there to be a positive relationship between the increase in sales and increase in accounts receivable. Now, looking down at plant assets, they've declined from 57.3 to 53.6. That's good news if we are operating efficiently, meaning we're getting more out of the assets we have. That would be a positive thing. But if it means that we're not reinvesting in the equipment in the company, then that would be perceived as not a favorable, but rather an unfavorable event. Let's look at accounts payable. We moved from 16.9 to 24.9% of total assets. And that just simply may reveal some liquidity constraints. Number 5, common stock. It has markedly declined from 36.5 to 31.4, and that could reflect a stock buyout program or other mechanisms to reduce shares outstanding. Now, when I actually look at the dollar, the common dollar amount, I'm more inclined to say nothing's happened in common stock. The common stock has been stable all 3 years. The percent of assets shift is just due to the change in the mix of the other assets and liabilities that make up the business. And that takes care of the analysis component. So there in front of you is the full answer in green, and the analysis components requires you to compare the numbers going across, but certainly don't do it in a vacuum. You need to look at the entire balance sheet and the income statement taken as a whole, and in this problem we're not really addressing